Hi folks, welcome to Code and Concrete, where we share the latest trends and the stories of trailblazers in the built environment. I'm your host, Matthew Schneider, the CEO at Building Inc. Joining me today is Lauren Brychell. She's an accomplished entrepreneur and investor relations expert with extensive experience in capital raising and commercial real estate investing. Over the course of her career, Lauren has successfully raised more than $75 million for diverse real estate ventures, showcasing her expertise in building strategic partnerships and driving investor success. Lauren, we first met at the Hawaii Self-Storage Unconference, which was fantastic. Why don't we pick up the conversation there? How did you get out to that unconference? And thanks for being on the show, by the way.
Absolutely. Thank you for having me. Gosh, so I was thrilled to come back to that conference for the second or third time. Tron asked me to speak again on just that exact topic of raising capital, investor relations, because that is something that most every business, especially in the storage and commercial real estate space, needs. Is everyone always needs more investors and more capital. So right. I was lucky enough to come back and speak on that topic.
Yeah, Tron was on an earlier episode of the show, and he was talking about self-storage, some inside hints and tricks to, finding the best location and how to market. So he's also talking about marketing. And I'm sure there's a lot of overlap between marketing methodologies and raising capital, because at the end of the day, it's all about how do you capture the attention of investors with your deal, win them over, win their confidence, and then ultimately close them. So I love that. And I've been in the capital raising scene. I have to say it's like the worst thing ever. I despise it. I think a lot of people do. And it's always good to have experts like you who know how to work through it, work the workflows, navigate people's emotions, their pushback, their objections to deals. So
Absolutely.
Let's start there, because it all starts with a conversation with someone. Hey, I want you to invest in this project. What are people getting wrong when they're having those investor conversations, and what should they be focusing on instead?
Yeah, great question. So I think there's a couple things that go wrong. Is one, the folks that are looking for the capital are forgetting that they are building relationships with these investors. It's not a transaction. You're not selling a used car. You are building relationship and building trust with these investors so that they're placing their hard-earned capital in your hands, and they are believing in you to take this project and this pro forma that you've put in front of them to completion and beyond and actually hit those projections. And so I think the biggest mistake that people make is not remembering that. This should be a long-term relationship like with a friend. Your relationship and the trust that you're building comes first. Second thing people get wrong is they pitch too early. They almost look desperate. They're almost asking for the capital when really they should be learning about the investor, what their goals are, why they're looking to invest, learning more about their experience, and tailoring the conversation that way, because they lose a lot of people when they pitch a deal right off the bat on the first conversation, even on that second conversation. And so taking a step back, taking it slow, making sure you're not coming across desperate is, really important. And then, after that, I would say changing the mindset from asking for capital to presenting an opportunity that's going to help someone or change their financial outlook. That's a big one that a lot of people have to overcome. Is you're not asking for the capital. You are helping them with an opportunity that could help them down the future for whatever their goals are. And with that, it's hard for people to sometimes overcome that. Like, gosh, I don't want to ask my friends and family for capital, especially when they're getting started, because it's awkward, it's uncomfortable. But helping or changing that mindset really does help with, no, we're not asking. It's not an awkward conversation. You're investing in this because you believe in it and you're passionate about it and you're good at it. So invite them in to also take a part of this great opportunity.
Right, absolutely. If you believe in what you're doing and you're presenting them a legitimate deal, you should have utmost confidence in bringing it to them. It should be exciting that you can generate a return together instead of just, hey, I need your money, right? That sounds like It's not going to work out. And that perspective, how you poise that offer to them is everything. Now, I'm curious about getting into the conversation and how quickly you want to do that, because some people say, cut the fat, let's get to the chase. You want my money. I'm an investor. Just ask me straightforward. Don't try to pretend to be my friend and, ask all these leading questions. And then there's the curveball. Hey, by the way, I need $100,000.
Right.
How do you balance like being transparent and honest while also building a relationship with investors?
Sure. Great point. I think it's, having that fine balance of listening to them and their needs and everything else with also giving them the proper information to make those informed investment decisions. I also think a big piece that plays into this is who your investors are, right? If they are a first-time investor investing their first 50K, a relationship's going to go really farther because they're going to want to they're going to be really investing in that person versus the deal because they don't know any better, right? They're going to go off of the feeling and the gut feeling that they get. And so that matters. If you're investing with a family office, that relationship is going to come first because if you pitch a family office on the first phone call, they're never going to talk to you again, right? But on that flip side, if your investor base is, high tech CEOs, for example, and they're super, super busy and they've got 5 minutes to talk to you and they don't care about the next 100 grand because they've got way more where that comes from, right? They're going to care less about the relationship. So it's understanding who your investors are and then tailoring that conversation and just kind of using some personable skills there, right? Kind of read the room and see how that conversation's going. Because to your point, if you are talking to a high-powered exec that wants to get off the phone quickly and they need the top 5 most important things out the deal and you're asking them about their future travel plans, it's not going to go well. So kind of read the room and understand how people work.
100%. As I think about it, a lot of the best investors are folks that you did not initially think were investors. And it goes back to the relationship piece. They say that the best time to plant a tree was 10 years ago. And it's a similar thing with investments. You can call upon relationships that you've had for 10 years. And I want to ask, how do you really develop that long-term trust with people to the point where eventually they would have the confidence to invest something with you financially? Because that it can be a tricky pivot. Here's my spouse, here's a best friend, here's a colleague, but now I have a financial responsibility to act and grow their capital. What's a good way to make that transition and maintain that trust?
Yeah, good question. So I think, the main thing there is educating them around the deal, right? So you've got this opportunity. You work in this, say, commercial real estate world. This is your bread and butter. You do this every day. They might have no idea what you do, but to your point, you've known them forever. They trust you. They like you. They know you and a little bit about what you're doing. So I would start with a little bit of a, hey, as you know, here's what I've been up to, and I'd love to share more about it with you. Very low key, non-sales pitchy. Are you interested in hearing more? I've got this cool new self-storage property in Georgia I've been working on. Here's why I love the market. Educating them on the fundamentals of the deal, not talking about any return metrics or asking them to invest, but just getting their mind thinking a little bit like, oh yeah, that does sound like an interesting opportunity. Maybe I'm not as diversified as I should be. I would love extra cash flow from another source. So talking to them about fundamentals and why you're investing in this and how it's changed your life is a great segue into it. Because it's non-threatening, it's casual, you're adding value to the conversation. And then if they say from there, well, gosh, that sounds like something I'd be really interested in. That's when you can truly pitch a deal to them and have them almost approach you from that perspective versus you just bringing it to them and they're caught off guard and they have no idea what you're talking about. And they're not primed for that conversation at all because that tends to not go very well.
I see. And these folks, would we classify them generally as retail investors? Of course, there's the accreditation class, but that still falls under retail, right?
Yes, it does. Retail, friends and family, retail, maybe high net worth, depending on exactly where they fall in that category.
So how do we start to differentiate retail investors from institutional investors? Like what makes that classification? And how does that change how you pitch to either of those parties? Like what's the best tactic for retail? What's the best tactic for institutional?
Sure. So I would say that retail is going to be a lot more emotion, relationship focused than an institutional investor would be. Institutional investors are going to be very large scale investors, maybe a $3 to $7 million average check size on the low end. That could be pension funds, endowment funds, large corporations. You're talking institutional capital at a large scale with real businesses behind them and people on their team who only vet these investment opportunities for these funds or plans or whatever they're investing for. And so they're going to be a lot more data driven. They're going to have an entire team on the legal, finance, accounting, due diligence side, and it's going to be a completely different experience for you as a GP, fund manager, whoever it is talking to these folks. And traditionally, retail investors, while they're more relationship, emotion based when they're making these decisions, have lower check sizes. Generally speaking, they're usually going to be a lot more passive as well, and they're going to be, even though the deal is passive to begin with, they're going to be way more hands off. They're not going to be involved at all. They have a W-2 probably. They don't have time for that. But the institutions, on the other hand, will be a lot more involved. People always like to say that they'll eat your lunch. They come in, they want special terms. They want way more ownership, way more control. They're not as much of a passive partner, but they do bring a larger check size. And so there's pros and cons. And just depending what you as a firm want to do, right? If you want a lot, of retail investors, smaller check sizes, but less involved, or do you want a couple of institutional partners who are much more involved and much more controlling? It's just kind of a personal preference there.
That leads into one of my next questions. I know that you advocate for crowdfunding, and I have too in the past. I think democratizing deals is a great opportunity for people. Again, saying like, hey, this is an opportunity, because usually it is exclusive to the institutions. They are the ones that can perform the due diligence or the off-market deals and write the check sizes required. But let's say that you're going to raise $5 to $10 million. How do I weigh the pros and cons? And you alluded to it with the control and maybe how quickly the fundraising can be completed. But how do I weigh the pros and cons of one person or company on my cap table, $10 million check, deal is done, versus maybe 15 investors, 50 investors, or going to a platform that opens it up to 500 investors? Should we navigate that decision?
Sure. I would say, from a risk perspective, on the one side, if you have one partner, that's kind of putting all of your eggs in one basket. If they've said, okay, we're going to capitalize 90% of your deals going forward, if they decide they don't like the performance or the management or whatever, they could be pulling out. And therefore, now you have zero capital partners down the road. So that could be a potential risk that it's something you need to weigh. On the other side, things that I would be thinking about are, what's the bandwidth of your team? Do you have the capacity to give a great investor experience to 15, 50, 500 retail investors? Because you're going to be talking to them consistently. They're going to be wanting updates. You're going to be sending out monthly, quarterly updates, whatever. They're going to be calling, texting. Being able to give them a great experience just kind of depends on the bandwidth of your team. I would also say, a marketing budget is an important thing to consider here as well. When you're going out and you're needing new investors, investor acquisition can be sort of expensive, whether you're doing online advertising, flying around the country, meeting people, going to events, doing all that networking that, adds up. So unless you've got a whole pipeline of people at your back door or in your city or being referred to you that it's a lower cost, it's decently expensive to continue the marketing efforts to acquire new investors. And so those would be the top things that I would consider before going with one or two larger partners versus a lot of different retail investors. I would say, having more of a pipeline of retail investors, though, does help when, some people want in, some people don't. At least you can go to other options if the deal is not fully funded. Sometimes people do the fund manager route and they bring in the capital for you, which has its own risks of, okay, what if they commit to $2 million and they can only bring in $1 million at the end of the day? And then you're the one stuck with that denominator of lack of capital. So there's a couple different ways to look at it, just depending on, again, bandwidth, budget, interests, all those things.
Just out of curiosity, how did you first get into the crowdfunding scene? What caught your attention about that?
Sure. So, kind of a funny story. I actually knew nothing about it when I first got into it. I started with a firm out here in Colorado back in 2019, and they hired me for marketing because that was my background at the time. And they were smaller and growing, and I quickly it was doing the marketing for them, but also hopped over the fence to the investor relations and fundraising side as the founder saw something in me that I would be a good fit for it. And the rest is history. I had to learn all of it. He was a great mentor to me and definitely quite the learning curve when you come from a marketing background, but totally worth it. I think it's so much fun.
Yeah, and I've seen some really successful crowdfunding campaigns, particular to real estate, I should say, and it's so heavily dependent on marketing and people who know how to make a deal very attractive. But it's, to whom are you making it attractive? And the most successful real estate deals that I saw that raised via crowdfunding, it was 3D printed modular homes. And it made complete sense. Like, yes, the people investing into the company and the deals are also going to be potentially living in one. Like, they want to put it in their backyard, or they want to create a hospitality park full of these kind of off the grid living where people can venture into. And it's that sort of a little bit of psychology, like what's going on in the minds of the people who would be investing, to understand. And that's why marketing is a super valuable approach that would be overlooked if you're just doing a traditional private equity deal, which is, hey, call in the nerdiest people, get all the pro forma, and show our sensitivity analysis and how this is bulletproof. But
Right.
not so much on the retail side. But this is a double-edged sword. So I want to switch to the perspective of the investor. They're getting into a deal. It's passive. There's layers of documentation and terms. They probably it can be overwhelming. You might not understand it.
Yep.
How do we make sure that we're being smart about the deals that we're passively investing into and protecting ourselves?
Yeah, that's a great question. Thankfully, these days there are a lot of great resources for limited partners to go to and learn and network with other LPs and learn a little bit more about how to properly do the due diligence on these firms. Because even as a couple of years ago, it was much harder and people found themselves in sticky situations because they didn't know the questions to ask or the things to look for, to your point. And so I would say, as an LP, put yourself in these forums and these communities of other passive investors who have been doing this for a long time, who are sharing their wisdom and knowledge, red flags to look for, with passive pockets and forums like that. Those are great resources for people who are just starting out. I would say, attending local meetups and events in your area is also a great way to build a community of investors, again, to learn from them and to pitch ideas to them. AI is actually a great tool nowadays as well to upload a PPM or an operating agreement or whatever it is into, say ChatGPT. Ask it what the potential risks are that it sees. Ask them about the sponsors. Do they have any criminal backgrounds? That's a really quick way to get information. Obviously, you need to verify it, but it's incredible what you'll pull out of that. And so, asking, say, for example, what are the risks? What are the questions that I should be asking the sponsor? Take those out and then take the most important ones back and say, hey, what are the answers to these questions? I'd like to know. So I think that's an easy way if you're really brand new to it to start learning and asking some better questions. But, with YouTube and all these other resources, it's easier to learn on, okay, how do you properly read an underwriting file? What are the red flags to look for? What's a sensitivity analysis? What does the cap rate at the exit have to do with everything else? And how should I be looking at that? And just, seemingly simple things that we know now that people would not know when they're starting are great to go out and research and take the time to do. And last thing I'll add here is there are people out there that you can pay nowadays to do the due diligence for you. And I think you should still learn yourself and do a lot of it yourself. But if you really are brand new and you don't have any interest in learning or the time, before you invest $50,000, $100,000, it's worth it to pay $500,000 to an expert to go through it and bring these points up to you so you can finalize them and feel good about them before actually placing the capital.
Should clarify, $500 to $1,000, not $500,000.
Yes. Correct. Yes.
That's interesting. How would you compare that role, like someone performing due diligence on your behalf, to a lead investor? Lots of deals have a lead investor, and that is like an indicator that due diligence has been performed. I guess to me, I don't know why I would pay someone for due diligence. I would be looking more for someone who has skin in the game, which would be a lead investor. I mean, is that super common on these crowdfunded deals or
You
anything in
know,
general?
Yeah, it depends. On your typical syndication, where you're investing directly as an LP with the GP, a lead investor is not quite as common. If you're investing with a fund manager or someone who is doing that due diligence on your behalf and putting together special side letters for you and better terms, and you're investing with them, ideally, yes, they are the expert. I would still caution to do your own due diligence on everyone else, the fund manager, the lead sponsor, all their track record and history as well, because sometimes things can be overlooked. And so, yeah, I mean, I would always caution anyone, no matter what deal, no matter what lead sponsor, to still do some of their own due diligence.
Yeah, and I don't mean to throw a jab at anyone whose responsibility is that, but it's sort of like the dilemma with consultants. If there is no accountability, it can be tough to say if this is the best advice that I'm receiving. Some folks are just doing it for the payment. Pay me the $1,000 and I'll tell you, yeah, it's okay. Whatever. You can't sue me for that. And that's where a big issue occurs.
That's true. Yeah. I would say when you're looking to hire a consultant like that to do your due diligence for you, having a really good understanding of, why they are qualified to be your consultant is important.
So thinking about, because you can perform due diligence in the beginning, and that's the easiest part, in my opinion. Then the project breaks ground, and this is where deals start to fall apart. It's where projects literally fall apart. Things can become disastrous. Next thing you know, we're underwater, the thing's being demolished, class action lawsuit, like lots of problems can arise. So for both parties, and granted, it's one-sided. It's one-way communication. Usually, if you have a lot of investors, you're like, hey, take it up with the platform, or I don't have time to respond to 50 different texts every single day. But how can we be proactive with our communication? How can we ensure transparency, not just at the beginning of the deal when everything is perfect numbers in the spreadsheet, but once those things start to fall apart a little bit, or new variables are introduced, how do we prolong trust and transparency throughout the project lifecycle?
Yep, great question. So I think the most important thing as a sponsor or a fund manager that you can do is put together and spend a lot of time and energy putting together consistent quality reports for your investors, whether it's monthly or quarterly, ideally monthly. That really does tell a story of the good, the bad, the ugly, right? Because that's, in theory, the best way to keep everyone at bay with what's going on, keep them feeling like they're in the loop. And you can put out the information ahead of time before you miss distributions, and then they're wondering why, right? So getting ahead of that communication, even when it's really hard to give them bad news, it's always worth it to put it out there up front and put together a detailed, report, because a high level, templatized or generic report is not really going to cut it, especially for long. And that's when you're going to start getting a ton of questions, emails, texts from investors, is when they're not feeling in the loop. They're feeling that their capital is at risk, like something's going on. That's when you start having those issues. If you're proactive with great quality communications, you're not going to have those issues. And that kind of ties back again to when you're thinking about the type of investors that you want. What's your bandwidth for that? Do you have an investor relations team that's willing to field those questions timely and accurately? Because that's going to either make or break the investor experience. Yes, they've given you the capital, they're in, but this is going to affect whether they invest again, whether they refer their friends, kind of their whole view on you. And so it's important to be prepared for that when you're thinking about, okay, do I want 50 retail investors? Can I take care of this? And then also, noting what are the frequently asked questions that they're bringing to me. Okay, now let's proactively add those types of things into the next communication so that their questions that everyone's got are being answered.
Are there any tools that stand out that streamline this process?
There are. You can really go crazy with some custom AI tools to spit out newsletters. usually with some custom GPTs and things and filtering reports into them. But it's something that generally is a bit more of a manual process because it's usually a lot of different pieces of financial data and property management data and ops and all those different pieces that go into it that need to culminate those updates. And so while you can, put bits and pieces of it into AI to do for you, it really should have a human touch to it because investors do notice when things aren't quite right, when they don't come across the screen correctly.
And what are some of those items, the big red flags that investors are identifying? Of course, there's surface level, we're spending more than we're making, or we're behind schedule. Is there anything else that stands out that is indicative that a project is in trouble? Like what should investors be on edge about?
I think it's when either the sponsor is late on communicating after being on time for a long time. That can raise some red flags, which is something so simple, right? You usually send out your updates on the first of the month, and now you're late month after month, and that's going to put some red flags out. If your updates are more generic than usual, and you're not giving the detail as to the why or what's going on and how are you fixing it. I think to your point, the numbers don't lie. If they don't share numbers, or if the numbers don't seem quite right, or if there's no context with the numbers. For example, okay, our expenses are higher than what we're making this month, so we're under. But they're not explaining how that's going to affect the distributions. And oh, by the way, you're not going to have distributions the next 3 months. Forgetting that why before you just cut them is important, and investors will definitely notice that. So I would say those are some of the small things.
Solid. Well, we'll segue a little bit back to the sponsor side. If you're trying to reach a large number of investors, maybe you're building up a network from scratch, how do you suggest that they go about doing that?
Great question. So I would start with figuring out who you want these investors in your network to be, because obviously there are a ton of different types. You could go the family office, the institutional route, the accredited investor route. But within that accredited investor, for example, there's doctors, lawyers, tech professionals. So pick one or two or three that really speak to you and that you resonate with. And that you like to work with. Some people really like to talk data, and so they might go for the engineer tech executive type because they also like to talk data. So, figuring out what's going to be a great match for you is an important way to start. That way you can also hone in your messaging. Okay, how do we talk to these people? What's going to be the most effective messaging for them to see us, come to us, invest with us? So once you figure those parts out, then it really is budget dependent. Do you have time to go to every single meetup in town and try to build your list at a lower cost? Yes, great. Do you have a massive marketing budget and all you want to do is online advertisements tailored to your avatar? Perfect. Then you can spend $50,000 a month if you wanted to on Meta and LinkedIn ads and build up a great Rolodex that way. So it's pretty dependent on your needs, your budget, your time, and who your avatar is.
I feel like a lot of folks think that there's a secret behind the red curtain for how you acquire investor networks, but it's really quite scrappy. It's a long, drawn-out process. A few of these ways you've described, maybe it's just going to events, collecting names, getting emails, putting that into HubSpots, and a year later you've accumulated 1,500 contacts. And
right.
Hey, if even 5% of those invest at a decent check size, you've got a deal funded. And advertisements, that's one way. What about social media? Are you seeing that, like reaching out to people on LinkedIn, direct messaging, connecting, is that decently effective?
I've heard really mixed feedback on that. Some people swear by it. Other people think it's totally crazy and way too used car salesman-esque. And so I think there is an art to it, and you can do it. Again, depending on what your avatar looks like, potentially. But I think there are better ways. I think that's pretty tough, and I think a lot of investors are being hammered on LinkedIn these days, and honestly, they're kind of sick of getting a sales pitch in their inbox without knowing who the heck you are. So it works in certain cases, but others it does not. I think, becoming some sort of brand on LinkedIn, on social media is great. Putting your story out there, talking about why you're doing these deals, talking about the ups and downs, and putting a real name and story around the real estate brand or whatever you're trying to do is great. Then you kind of accumulate a following, and that's when you have a better chance of bringing in leads through social media that are more interested in a higher likelihood to convert. So I think that's great. And then I think another piece that, we didn't quite mention is just be everywhere as much as you can. Write articles, go on to podcasts. I mean, that's, low cost, low effort thing that you can do to get your name out everywhere and get your story out. And it's a great way to start as well if you have a lower budget.
My playbook has just been exposed here. It's like you're reading my mind. I mean, that's how I've been able to get checks written out to our companies or direct people towards deals, acquire new clients, and build up partnerships. It's all been a personal branding campaign online. And I do exist everywhere. It's all across LinkedIn. It's on the major streaming platforms, X, formerly Twitter, Instagram, and then in person. Maybe you don't know my online presence, but you see me in person at an event and I'm speaking. I'm holding a microphone. And a quick Google search, I'm SEO optimized. You can look up my name and you'll see pictures of me. So all of this adds a lot of credibility. And as we mentioned in the very beginning, when people are investing into a deal, a lot of it is dependent on who is behind the deal. Like, what is their track record? And maybe it's not directly real estate, but have they demonstrated themselves in other areas? Do they put their money where their mouth is? Do they execute? Do they at least have the knowledge around this subject that we're looking for? Maybe you say, I'm going to go build a data center. All right, well, who do you know? Oh, you're ex-Intel. Okay, I believe it. I think you could put together a team that follows through and makes this a success. So it's just a lot of people are on edge about putting out that much information, but there's a generational shift happening, and having an online footprint that's, one, can be discovered, and two, is clean, raises more green flags than red flags. If I am thinking about working with someone and I can't find any information on them, like if I type in their name, type in the state that they're in, nothing pops up. It's like, okay, that's interesting. Usually you get a Facebook account at least, and nothing on LinkedIn. Where'd you work? Where'd you go to school? Nothing. Oh, I just don't want to be found. Okay, well, why not? Like, what don't I know here? And how do I know that when you start telling me things that it's the truth? So there's no better receipt of performance than something like social media. 10 years ago, scroll down my timeline and you can see what I was doing, who I was shaking hands with, what was being accomplished. And in this time, in this era, super valuable tool for sure.
Agreed.
So before the show, you said that you were pivoting it. Before you were 100% on the crowdfund train. Now you've entered slightly new line of work. Want to tell us a little bit about that?
Sure. Yep. So myself and a partner started a firm down in Georgia recently that is a U.S.-based call center for real estate firms, private equity firms, helping them qualify their leads when they have a massive amount of inbound leads that they just don't have time for. What happens is usually they don't either have a great system to track the inbound leads. They get lost. There's no great notes. They don't have time to get the adequate amount of touch points out, emails, phone calls, text messages to get them to book a call and to learn more about them and their investing goals. And so it's very simple. All we do is we qualify these leads, make sure they're accredited, make sure they're actually interested in investing. And then those hottest lead prospects, we book them on the client's calendar so that they only have to talk to maybe 10 investors a week instead of 200 or 300 like we're talking to for them. And so it really maximizes their efficiency and helps convert the capital much faster for them. So that's it.
How do you determine what a hot, good lead is?
Well, one, they're responsive. Two, they're actually accredited. They understand, what they're investing in. They've maybe invested before, or they're actively interested in pursuing some sort of passive investment. They ask great questions, and then that's usually the best way that we can tell that they're qualified. Of course, not a perfect science, but it tends to work out pretty well.
And this is for real estate developers, asset managers who want to raise capital. That's right?
Correct. Yep. So could be real estate, could be any asset class that is bringing in outside investors.
Okay. So Well, that really opens up the doors, right? I mean, you could be fundraising for anything.
Right. So
Okay,
far,
so
we've stuck
it's
mostly real estate, but yeah,
okay.
I mean, the opportunities are endless.
So it is agnostic to industry then.
Mm-hmm.
Okay, good to know. Good to know. And what's the name of this firm?
Currently, it's called Predictive IR. So we've only soft launched. You won't be able to find us anywhere yet. You just have to know us to get in.
All right. So listeners are getting some alpha. That's fun. Inside scoop.
Yes.
And then so is Equity Elevated still running, or
It
is the transition happening?
Nope. So that's its own separate firm that is still alive and well.
Okay, so you've got multiple ventures that you're juggling here.
Yes.
Awesome. Well, this has been insightful talking about raising capital. It's much more fun to talk about raising capital than actually going out and doing it, but it's great to have folks like you who can guide people through the process, because it can be a very nervous endeavor and very time consuming if you don't execute it correctly. And then we haven't even talked about the regulatory side, and we're not going to, but that's its own battle. Security exemptions, what are those? Mm-hmm. I just took people's money and posted it online everywhere. Yeah, well, that's troublesome.
Correct.
So I really appreciate you, Lauren, walking us through all of this, sharing some insight. How can people get in touch with you?
Absolutely. Thanks for having me on today. People can find me at equity-elevated.com, or Lauren at equity-elevated.com is my email.
And you're pretty prominent on LinkedIn? So?
I'm there. You can find me.
Okay. Well, I'll make sure to provide links for all of that in the show notes that people can reach out and get involved. And final thank you for everyone who tuned in. Really encourage you to reach out to Lauren if you're looking to get into the fundraising scene. And if you did enjoy the show and all of our past speakers and you want to support Lauren and our future speakers, be sure to leave 5 stars on wherever you're listening, Apple, Spotify, like and subscribe on YouTube. Other than that, I think this is a wrap. Thank you again, Lauren.
Thank you.